In this presentation, we will continue on with our corporation comprehensive problem entering the adjusting journal entry related to unearned revenue. For more accounting information and accounting courses, visit our website at accountinginstruction.info. We have our information up top. We're going to enter that into our general journal and post it to our worksheet. We have the prior adjusting journal entries here, so this should look similar to the worksheet if you're going to work this by hand. We have the adjusting journal entry we are focusing in on here: unearned income, unearned revenue, unearned fees. So we're going to go through our normal process here, thinking about our adjusting journal entries thought process to see the two accounts that will be affected. And then we'll go back and think about what is unearned income, what is unearned fees, why are we doing this? So the adjusting journal entries do not deal with cash, and we're going to have one account that's going to be a balance sheet account, not cash. More specifically, it's going to be an asset or liability account. And if we look through those, typically it's going to say here, unearned fees. We could call it revenue. Fees if it's a service company. Unearned revenue, it could be unearned sales possibly, but it's unearned revenue or income. That's going to be our first account. Now, if it's a book problem, they'll often tell us that in the question. They'll be saying, we're dealing with unearned revenue. And because they're going to tell us what it is at a specific point in time. So even if we don't know what unearned revenue is, we can find that. Then there's going to be an income statement account down here related to unearned revenue. Now, if we go through these, none of them really make sense except for revenue. So, right? And that one is a little bit tricky because we might think, well, you know, it's the second word, so we might not really recognize it as easily as we have some of the other ones where it's just basically says exactly what it is, like supplies or insurance or something like that. So revenue is the other side of this. Now, this is usually the most tricky one for most people to understand for a few different reasons. And one is that we're dealing with revenue here as opposed to expenses. Most of our transactions, our adjustments, are going to be dealing with expenses because there's a whole lot more expenses that we have to deal with than revenue. This one deals with revenue, but the same rule applies in that revenue only goes up. It's just that revenue goes up in the credit direction. Revenue is a credit balance, normal balance account. It's going to go up in the credit direction. So if we apply the same rules, we're going to say, well, it's a credit, it's going to go up. We're going to credit revenue. That means we must be debiting unearned fees. So we know the journal entry is going to be this. We're going to debit unearned fees or unearned income, and we're going to credit revenue or income, whatever the account may be calling it. It's going to be a revenue or income account, liability account. So we don't really know how we got the number here yet, but we know we're going to debit the unearned fees and credit revenue. So now let's think through, why are we going to do this? What are we doing here? Now, the other reason this is a little bit tricky for an adjusting journal entry is because not all companies have unearned fees. So this is another area where we have to think, well, where did unearned fees or unearned revenue come from? How does it get on the books? So in our problem, we can go back and look because we've seen it. In other book problems, we're just going to have to basically imagine, well, how would that get there? And it has to do with us getting money before we do work, something that not all companies do. Meaning it would happen if we got paid, we got cash, debit cash, but we hadn't yet done the work. We can't credit revenue. We credit a liability representing the fact that we owe something in the future. And that only happens in certain industries, like if I had a newspaper industry and we got paid for a subscription before, or any application industry now is often in a service base. We get money before we provide the application. So in that case, that's where this liability comes from. So what are we going to do in the adjusting journal entry process? We're going to say, how much, if the normal practice is this, we're going to tell our accounting department, every time you get cash, because we have a computer application company, and we sell our apps before we provide the service, every time you get money, every time you get a new person, a sale, you're going to debit cash and credit not revenue, but unearned revenue. And then at the end of each time period, at the end of each month, we're going to determine how much of that revenue has been earned through us actually providing the service, the software in that case. So that's what we are doing now. That means that most of the time when they give this problem, they're going to say, this is what unearned revenue should be. In other words, there's two ways that we can say this problem. We can say, of this 3,000, this is how much has been earned this month. which means we would just use that 1,000 if that's how they phrased it. Or we can say this is what unearned fees still is. This is what the liability still is at the end of the month, which is typically the way we phrase it, meaning this number needs to be 1,000 after the journal entry. So that would mean that it has to be a subtraction problem. We got to take the 3,000 minus the 1,000. In other words, we have to bring the 3,000 down by 2,000 to get it to the 1,000 they're telling us it should be. So that's what we come up with is 2,000. And then we're going to recognize the revenue when we actually earned it, when we did the work. Increasing revenue, 27,000 goes up in the credit direction. Okay, so if we do that, then if we post this out, we're going to say that the unearned fees was at 3,000. It's going to go down by 2,000 to 1,000. The revenue or income is going to go from 27,000 up by 2,000 to 29,000. Notice this is the one transaction that we've seen so far that actually increases the revenue. So our adjusting entry actually increased us and makes us look better. Our net income is going up and our liabilities are going down. So if we look at our worksheet for all of our transactions here, here's the new transaction we did right here. Here's all the other transactions. So at the end of the day so far, here are all of our unadjusted trial balances. Here's the adjustments we've made. And again, note how we can tick and tie each one of these out to each journal entry. We can look at the debit and credit. We can mark them off if we want to for each journal entry. And oftentimes we do that. We did this with a little tick here. If I wanted to say the insurance is going to be an X, and then we can go to the insurance and mark it off and say, well, the insurance is this one and the insurance is this one. There's the debit and credit there. And if we want to represent the supplies as a little O, so we're going to say the supplies is here, and we can mark and tick and tie everything off in some kind of formulaic format and see exactly what is working here. This is why this worksheet works really, really well when we have just a few journal entries we're going to be dealing with. We can see that if we started with something with 0, we entered all these adjustments that add up to 0, meaning debits minus the credits equals 0. We end up with something where the debits minus the credits equals 0. And the total effect on net income is revenue minus expenses. Now this one brought net income up a bit. All the other ones have brought basically net income down. So of all this, 29,000 revenue minus all these expenses is 7,100 income. The revenue still greater. The credit's greater than the expenses. But we've started at 19,600. We brought it down from all these adjusting entries by these accounts here, 12,500 to 7,100, which is the 29,000 minus all the expenses. For more accounting information and accounting courses, visit our website at accountinginstruction.info.